Many of us love the idea of building a portfolio of dividend stocks, living off the passive income forever, and never having to touch the principal. It sounds like the ultimate financial dream. This diagram shows the exact math you need to make that dream a reality. You simply take your target annual passive income and divide it by your portfolio's dividend yield percentage. That gives you the total capital needed. Let's plug in real numbers using Pepsi, which currently offers a dividend yield around 3.8%. If your goal is $50,000 a year in passive income, divide $50,000 by 0.038. The result is a massive $1.3 million needed up front. And if you choose a company with a lower yield, like Apple, at roughly 0.39%, the math gets brutal. To get that same $50,000 payout, the required capital skyrockets past $12.5 million. From looking at a lot of actual dividend portfolios, a realistic average yield hovers between 2.5 and 3.5%. That means you are generally looking at needing $1.4 to $2 million invested to hit that $50,000 mark. For context, the median net worth in America is roughly $217,000. If you put that entire amount into a high-end 5% yield portfolio, it generates about $10,850 a year. That is not enough to live on. Getting to $2 million from scratch is difficult. Pure dividend investing requires a massive base of capital to work. It is an endgame strategy for the already wealthy to distribute cash, not an efficient shortcut for beginners to build wealth. When you see those capital requirements, the immediate temptation is to cheat the math. You might think about buying stocks with yields of 5 to 8%, so you don't need millions of dollars to start. This leads straight into what investors call a value trap. A massive dividend yield is often a massive red flag. It usually points to a distressed company trying to attract investors because its underlying stock price has plummeted. The company keeps shoveling cash out the top windows to keep shareholders happy, but beneath the surface, the actual foundation of the business is crumbling. We have seen this happen recently with companies that were once considered safe. 3M raised its dividend for 66 years straight before finally cutting it in 2024. AT&T slashed theirs by 46% in 2022, and Walgreens cut theirs after 40-plus years of increases. Every single dollar a company pays out to you as a dividend is a dollar they are not reinvesting back into their own survival, research, or growth. When the business eventually stops growing and reality sets in, they are forced to cut the dividend. You lose your reliable passive income stream, and simultaneously the underlying stock price crashes. Chasing an artificially high yield just to compensate for a smaller portfolio is dangerous. Over the long run, it mathematically guarantees you will lose your principal investment. Even if you avoid the value traps and pick stable companies, building a portfolio exclusively around dividends carries a severe hidden opportunity cost. Prioritizing cash payouts forces your portfolio into a very specific corner of the market. You end up over-concentrating in defensive, slow-growth sectors like utilities, healthcare, and consumer staples. By heavily weighting those mature industries, you actively starve your portfolio of the sectors that drive massive economic expansion, like technology and consumer discretionary spending. This chart highlights a backtest run on Vanguard data from 2016 to 2025. It compares a pure dividend portfolio against a total market blend. Even with the dividends reinvested, the dividend strategy grew at an annual rate of 9.43%, while the total market returned 10.49%. A single percentage point might look negligible year to year. But as this timeline extends over a 20-year horizon, that tiny difference compounds into hundreds of thousands of dollars in lost wealth.
This is the core trade-off you have to accept. Taking cash payouts today limits the ceiling of the stock's underlying price appreciation tomorrow. Optimizing solely for immediate cash flow artificially caps your portfolio's total return. You sacrifice massive, compounding future growth just to get small, immediate payouts now. We also need to look at dividend investing through the lens of the actual economy we're sitting in today, in 2026. If the average dividend aristocrat is paying out around a 3% yield, we have to ask why we are taking on the daily volatility of the stock market to get it. Looking at this risk-reward quadrant, Treasury bills and high-yield savings accounts currently offer very comparable yields to dividend stocks, but they sit in the near-zero risk category. You can secure that income without touching the stock market at all. Back in 2021, interest rates were essentially zero. If you wanted any kind of yield, you were forced to buy dividend stocks and accept the market risk that came with them. The macroeconomic environment dictates the rules of the game. When the interest rate environment shifts, your strategy has to adapt to what is actually available. Exposing your hard-earned capital to potential market crashes just to earn a 3% yield doesn't make sense when you can get the exact same payout completely risk-free today. So how do you actually apply this? The right approach depends entirely on your current life stage and how much capital you have. Let's break this down into a concrete strategy. Here is our decision tree. If you are under the age of 35, you have decades to recover from market dips. Your allocation should heavily favor a total market or growth strategy, keeping dividend assets between 0 and 5%. In this stage, a $10,000 portfolio yielding 4% pays you $400 a year. That doesn't move the needle. Your priority should be maximizing compound interest to build your capital base as fast as possible. As you cross age 35, the strategy shifts. In your late 30s, you might allocate 5 to 10% of your portfolio toward dividend ETFs. As you move into your 40s and 50s, that income allocation can safely scale up to 15 or even 50%, depending on your risk tolerance. Introducing these fixed income assets later in life provides reliable cash flow as you approach retirement, acting as a psychological buffer against market downturns. Even then, the core of your portfolio still needs to be rooted in growth assets to ensure your money outpaces inflation over a long retirement. Dividends are an end-game distribution mechanism designed to protect the wealth you have already accumulated. They are not an early-stage vehicle to help you build it. There is one final hurdle you have to clear if you choose this path: the invisible tax drag. Every time you receive a dividend, even if you reinvest it, the IRS wants a cut. If you buy and hold shares for longer than 60 days, your payouts become qualified dividends. This classification is vital because it taxes your income at much lower capital gains rates instead of ordinary income. Look at this capital gains tax table. If your total income falls under the roughly $49,450 threshold, your tax rate on those qualified dividends drops to 0%. If you are entirely retired and standard deductions are applied, you can effectively earn $50,000 a year purely from dividends and legally owe absolutely zero federal taxes on that money. Alternatively, if you build your dividend portfolio inside a Roth IRA instead of a standard brokerage, you bypass this entirely. The payouts compound tax-free. Whether you optimize for total market return or passive cash flow, the math doesn't lie. Applying the right strategy at the wrong time in your life will leave hundreds of thousands of dollars on the table.